So here is a bigger picture of an exercise that I've created for illustration of this template. What we're going to end up doing is doing some accounting. Like even in an introduction, we're going to jump right in and do some accounting. So I'm going to pull up the actual spreadsheet and we'll go through this handful of transactions to show how it works mechanically so that you can see that the mechanics are easy. The hard part is all the GAAP rules and policies and things like that. But the actual mechanics of accounting, especially if you use the template method, is very intuitive. I hope to demonstrate that to you so that you share my opinion that this method is intuitive and that this method does mimic the operation of an accounting system. All right, so here is the Excel spreadsheet and it's available to you so you can download it and look at it also. If you want to do it along with me, that's fine. So each of these rows represent transactions, right? And in an accounting system, each transaction has to be in balance. In other words, these little equal signs are not just there for decoration. It's a reminder that we have to be in balance row by row by row. Because if every row is in balance, then when you summarize the rows, their summary's in balance. You'll actually never be out of balance, theoretically. If every row is balanced, then the summary of all the rows must also balance, right? Simple. Now, we all make mistakes. We're human, right? So we'll have to find mistakes from time to time. But the logic is pure and it works. So let's prove that. First transaction, an investor buys $200,000 of your company's stock. Oh, what happened? I'll always ask you that. We got cash. How much cash? $200,000. Right? So I'll put we got $200,000, cash goes up. Notice that for the vast majority of what we're going to do, if it goes up, it's a plus. If it goes down, it's a minus. Pretty good, huh? All right. But that's one side. We're not in balance. Well, what's the other side of that entry? We sold common stock. And we sold $200,000 worth of common stock. In that account, it shows we had contributed capital of $200,000. Yeah, that's right. Somebody gave us money. And on this side, it shows we have cash of $200,000. Yeah, that's right. We got the money. And therefore, these are equal, right? I'm not going to do this every time, but I'm illustrating that the assets equals liabilities and equity. Right? Easy. Of course, we're going to start with an easy one. All right, let's try another one. We borrow $5,000 from the bank at a 10% interest rate payable in 3 years. Okay. What happened? We got money. How much? $5,000. So we got $5,000, cash goes up. Now what's the other side of it? Oh, I have a liability to a bank and it's a note payable. It's due in 3 years, more than 1 year. So I owe them $5,000. Right? So are we in balance? Does 5,000 equal 5,000? Yes, we're in balance. Check. Next, we buy a refrigerator for $1,000 payable next month to the supplier. So we bought something, but we didn't pay cash. So we bought, what did we buy? We bought some equipment. What's the value or historical cost, right, for accounting is $1,000. It went up. We had our assets go up by 1,000. And what happened? We owe money. So our payable, our vendor payable goes up by 1,000. Again, are we in balance? We have an asset and we borrowed money to get the asset. Now notice we could have paid cash. We have all this cash lying around. In that case, we would have put a negative 1,000 here. Then it would be a negative 1,000 and 1,000, and that would be in balance because it's zero. And this goes away because we paid cash, right? So this is just the scenario where we finance the refrigerator. Next, we buy $4,000 worth of inventory, and it's 8,000 bottles of lemonade at 50 cents a bottle, right? So we paid cash apparently. So that's 4,000. We spent 4,000, and now we're building inventory for 4,000, right? So cash goes out, it goes down, inventory goes up. We got more lemonade, so that goes up, right? Next is we sell some. We sold 1,000 bottles at $1 per bottle in cash. Cash goes up 1,000, and that's our first bit of revenue over here. That revenue went up. I'll delete it just to make it a little slower. So when we got $1,000 worth of cash, this is our first income statement transaction. We sold something to a customer. $1,000 worth. Now notice that behind the scenes in the Excel, I had it summarized that this transaction will increase my income by 1,000, and that in turn, through the articulation or connection between the balance sheet and income statement, makes retained earnings go up by 1,000. So once again, assets went up 1,000, liabilities and equity went up by 1,000. We're in balance, right? And this little separation here means that we're living our own little life in the green section of the income statement, but we tie it together through the connection of retained earnings. Oh, we forgot something. There's cost. We didn't just get money. We have to reduce our inventory. So 1,000 bottles at 50 cents a bottle cost us $500. So we have to reduce our inventory for the cost of what we sold, literally cost of sales. We have cost of goods sold, which reduces profit, is a negative. It goes down. Profits go down. So that's 500, and that reflects in retained earnings. Okay, hopefully you're still tracking with me. There are a few more to do. Next is we sell 5,000 bottles for 90 cents, but it's on account to a corporate customer. So we didn't get cash. We have a thing called accounts receivable. So let's just do that calculation. 5,000 bottles times 90 cents per bottle. So they paid us, or hopefully will soon, pay us $4,500 for the 5,000 bottles. Notice that it shows up here because I kind of automated it. But if this were blank, you would simply just enter 4500 and then make sure that this carries and connects the two statements, which of course it does. But we sold some lemonade, so we have to take out the cost. The 5,000 bottles cost us 50 cents each, so that's $2,500. And so here it costs us $2,500. So now we're back okay. Are we in balance? Yeah, the net of this is 2,000, and the net of change in retained earnings is 2,000, which is comprised of the revenue minus cost of goods sold, right? So that's that. Last, or not last, next is we owe 5% commission to a salesperson who got us that corporate account. Okay, thank you very much. I have an account called Accrued Commission. I'm going to owe more money to this person. How much more? 0.05 times the value of that contract is 4,500. I owe 225. That's an expense. This is a commission. And it's negative 225 because it's an expense. And so are we in balance? No assets moved, but liabilities of a plus 225 and equity of a negative 225 means we're in balance. Okay, good. Then we pay rent. We paid in cash, $500. And rent is an expense. Negative 500. And then we paid some salaries, $800. And now we're still in balance because these reductions in cash match with a reduction in retained earnings. All right. So congratulations, we have just done accounting. May not feel like it, but this is, in conceptual way, accounting. We had transactions. We posted transaction to the accounting system. Now we're going to do something with it. This orange row represents what we call the trial balance, where we accumulate, I'll just show you one of these formulas, accumulate everything that's above it, right? So now the net of all those cash transactions is we still have 200,700, and these are the balances for each of the accounts, whether they're in the income statement or the balance sheet. And a trial balance just says, okay, before we do anything further, let's make sure we're in balance. So this is, what is the total assets? Answer is 207. Next is, what's the total of liabilities and equity? This section here. Answer, same 207. We're in balance. Check. We can move forward.